Order. Thank you. I call to order the 13th meeting of the Standing Committee on Finance. We have a very special guest with us here this afternoon. Colleagues, we have the Governor of the Bank of Canada, Mr. Mark Carney, and pursuant to Standing Order 1082, he's here to discuss a study on the report of the Bank of Canada on monetary policy. As you all know, he appears twice a year before the Finance Committee, and we look forward to his presentations and a fulsome discussion of some very pertinent issues. Governor, Mr. Carney, welcome to the committee. Thank you so much for being with us here today. We look forward to your opening statement, and we'll have questions from members after your remarks. So please begin at any time.
Thank you very much, Mr. Chair, members of this committee. I'm very pleased to appear before you today to discuss the bank's views on the economy and our monetary policy stance. Before I take your questions, I would like to give you a few of the highlights from our latest monetary policy report, which was released last Thursday. La croissance économique mondiale a été un peu...
Global economic growth has been somewhat stronger than projected, with momentum in emerging market economies increasing noticeably and moderate recovery underway in most advanced economies. Global growth is now projected to average slightly above 4% a year through 2012. In Canada, the economic recovery is proceeding somewhat more rapidly than expected in January. It is supported by continued fiscal and monetary stimulus, improved financial conditions, the rebound in global economic growth, more favorable terms of trade, and increased business and household confidence. 2010 should mark the turning point when the private sector takes over from the public sector as the primary source of growth. GDP is now projected to grow by 3.7% in 2010, before slowing gradually to 3.1% in 2011 and 1.9% in 2012.
Stronger near-term global growth, very strong housing activity in Canada, and the bank's assessment that policy stimulus resulted in more expenditures being brought forward in late 2009 and early 2010 than expected. At the same time, the persistent strength of the Canadian dollar, Canada's poor relative productivity performance, and the low absolute level of U.S. demand will continue to act as significant drags on economic activity in Canada. The bank estimates that GDP in the first quarter of 2010 was about 1% below its peak in the third quarter of 2008 and some 2% below its potential. The economy is expected to return to full capacity in the second quarter of 2011, one quarter earlier than we had projected in January. The outlook for inflation reflects the combined influences of stronger domestic demand, slowing wage growth, and overall excess supply. Core inflation, which had been somewhat firmer than projected in January, is expected to ease slightly in the second quarter of 2010 as the effects of temporary factors dissipate and to remain near 2% throughout the rest of the projection period. Total CPI inflation is expected to be slightly higher than 2% over the coming year before returning to the target in the second half of 2011. Malgré le raffermissement de la reprise à l'échelle du globe,
despite the firming of the global and Canadian recoveries, there are considerable risks around the bank's outlook. There are two main upside risks to inflation. It is possible that the momentum in household expenditures and residential investment could be greater than currently expected. Internationally, a faster than expected global recovery could stimulate external demand for Canadian exports and improve the terms of trade. On the downside, the combination of the persistent strength of the Canadian dollar and Canada's poor relative productivity performance could exert a larger than expected drag on growth and put additional downward pressure on inflation.
Global economic recovery could be more protracted than currently projected. In this regard, there is a risk that sovereign credit concerns could intensify, leading to higher borrowing costs, and a more rapid tightening of fiscal policy in some countries. Either of those factors would restrain global private demand relative to the bank's base case projection. Over the medium term, global macroeconomic imbalances continue to pose significant risk to the outlook. While these imbalances narrowed during the recession, sustained improvement over the medium term will require fiscal consolidation in advanced countries, together with stronger domestic demand growth and real exchange rate adjustments in countries with large current account surpluses. In the absence of these measures, the cost of the global economy could be considerable. The G20 framework is designed to help the global economy move in the right direction, and this past weekend in Washington, the G20 reaffirmed its commitment to this important initiative. In Canada, in response to the sharp, synchronous global recession, the bank lowered its target rate rapidly over the course of 2008 and early 2009 to its lowest possible level. In addition, in April 2009, the bank committed to hold it at that level, conditional on the outlook for inflation. This unconventional policy provided considerable additional stimulus during a period of very weak economic conditions and major downside risks to the global and Canadian economies. With recent improvements in the economic outlook, the need for such extraordinary policy is now passing, and it is appropriate to begin to lessen the degree of monetary stimulus. And that is why on this Tuesday, 20th of April, the bank removed its conditional commitment. This, in and of itself, represents a tightening of monetary policy. Going forward, nothing is preordained. The extent and timing of any additional withdrawal of monetary stimulus will depend on the outlook for economic activity and inflation, and will be consistent with achieving the 2% inflation target. With that, I would be very pleased to take members' questions.
Okay, thank you very much, Mr. Carney, for your presentation. We'll start with Mr. McCallum with members' questions for 7 minutes.
Thank you, Mr. Chair, and thank you for being with us, Governor. I won't characterize your forecast as optimistic, which I did once, but I think I would still say at 3.7% for the current year, it's certainly higher than the consensus among private sector economists and others. And of course, it might be right. But on the other hand, but I want to raise the subject of debt, because in your report you say it is possible that the momentum in household expenditures could be greater than currently expected. I might have thought the contrary, because a lot of people have talked about the unprecedentedly high household debt, like 145% according to one authority. And OSFI has said that, and I quote, "The ability of households to service their debt obligations in the context of continued growth in credit and an environment of rising interest rates is an emerging source of risk for the medium term." And Royal Bank, Standard & Poor's, Certified General Accountants, various groups have all spoken about this issue of rising debt. So rather than thinking consumer spending might rise more quickly than predicted, I would have thought, especially if we do have rising interest rates, that the debt issue might be a negative factor that would slow down domestic expenditures.
Thank you. You left one institution out of that list of people who have been warning about the levels of household debt, and that's the Bank of Canada. We began warning about this issue in the fall of last year, very clearly, right, supported by quite detailed simulations, and I would say we share the concern that there are cohorts of Canadians, or there are groups of Canadians, who run the risk of being overextended on their personal finances. We've used every opportunity, and I'll use this one as well, to encourage people when they consider taking on additional debt to look at that obligation over the fullness of it, in other words, over the long term, and think about it in more normal circumstances. We still are in quite extraordinary circumstances with respect to borrowing. So that brings me to your question, which is a very welcome and important one. To be absolutely clear, a large portion of this debt, but not all of it, but a large portion of this debt, the recent run-up, has been related to the housing market. Now, not purely for housing purchases, but related to the housing markets in two ways. First, conventional mortgages, and then secondly, personal lines of credit, which have been secured against houses. and or so-called home equity loans is another way to put it. And in fact, the bulk of private consumer debt has been home equity in recent years. We see a marked weakening in housing activity over the course of our projection, starting from the second quarter of this year and over the balance. And in fact, you'll note in the detailed breakdown on page 20 of the report, when we go GDP growth by component, that actually housing activity subtracts from growth in 2011. Now, that's not the same as talking about specific prices, but in terms of the level of this activity, we see it coming down, and we do expect to see a moderation in debt. That said, credit growth in this country has continued to be quite strong, and in those situations, there is a risk that that momentum maintains itself for longer than expected. So we're expecting to see a coming off in the rate of credit growth. If it does not and persists for longer, then there is a risk of upside momentum. Now, there's a variety of factors, and I won't use up all your time, but I'm sure we'll get into it, why we expect to see this deceleration. And one final point is something that does characterize our forecast for this year is a front-loaded nature of the recovery, a much faster first quarter, second quarter, and then a gradual slowing.
Well, thank you. I'd like to change the subject completely and ask you what you see as the biggest challenge or risk globally over the medium term. And before you answer, I'd like to give you one candidate and see if you might agree. One concern that I have, I think many people, is that the United States deficit is very big, well over 10% of GDP. And that in itself might not be a huge problem, except I think a lot of people wonder if the United States political process, Senate, Congress, is capable of dealing with this kind of thing. We look at Social Security problems over decades. And so I think as Canada is so close to the United States, this is a concern not only for them, but for me. But do you see the U.S. President and Congress dealing effectively with this over coming years?
Well, I think the question was, what do we see as the largest risk over the medium term?
Globally, yeah.
And I would generalize it because we have been clear. Obviously, we generalized into global imbalances, but I want to talk specifically about fiscal. Very much the risk is getting the balance right on fiscal policy, and that means both being forced or accelerating the fiscal adjustment too quickly, or delaying it too long. In a number of major economies, the United States being perhaps the most prominent, but this is a common issue in a number of major economies, the need to get the balance right. And something I did highlight, and I won't go into detail because I'll just put the reference in a speech a few weeks ago here in Ottawa, we referenced this issue of the markets and political process actually accelerating adjustment on the fiscal side too quickly, and that driving deficient demand on a global level with knock-on effects. With respect to the United States, the fiscal challenge in the United States is considerable, and we would support calls for a sustainable fiscal plan to be outlined and implemented.
Thank you.
Okay. You have 30 seconds, if you like.
I don't think 30 seconds will do me much. Thank you very much.
Thank you. Thank you, Mr. McCallum. Monsieur Paet, s'il vous plaît, pour 7 minutes.
7 minutes. Thank you. Welcome. Obviously, and you've indicated clearly that even your presence here and your responses can have an impact in terms of tightening monetary policy, and we are aware of that. The fact that Canada's monetary policy of your bank depends on the target inflation rate of 2%. And that has been your policy for the past many years. It's almost become a religion. A religion to want to control at all cost that target 2% inflation rate. The problem is, and I'm trying to understand, in the private sector, there can be concerns that to lead this struggle to keep the inflation rate at that target rate could lead to a high exchange rate, and that the exchange rate could rise rapidly. We do have now parity in terms of the dollar, and you've said this, if ever productivity in Canada is rather low, we are not sufficiently using Canada's capacity. And as we know, as my colleague indicated, the U.S. economy is a drag. Is there not a threat of a too quick tightening of fiscal policy? And Mr. McCollum likes saying that he used to work for the Royal Bank and that his bank increased mortgage rates rather quickly. There seems to be an escalation. Things are moving faster than you would have hoped for. And I was wondering, of course, you can never correct what was said in the past, but even having warned last week that at the end of the second quarter, things would be moving up, is there not a danger to proceed too hastily with regard to tightening fiscal policy or monetary policy? Of course, I'm thinking for Quebecers, for small and medium enterprises, and for entrepreneurs. Thank you, Mr. Payet. There's no danger with regard to the Bank of Canada in terms of proceeding too quickly or too slowly. We have a very clear objective, as you have just indicated. That objective is a target inflation rate measured by a total CPI of 2%. It's not a religion. It's a mandate given to us by the people in Canada and by the Government of Canada. There's an agreement between the Government of Canada and the Bank of Canada, and that agreement is in effect until the end of 2011. If the Government of Canada and the Bank of Canada in the future want it to change that, it's possible. It's a choice. It's not a religion. But in our view, and according to the Government of Canada, the best contribution given by monetary policy is for Canadians' best interest, and to have a stable inflation rate, which is stable, predictable. Inflation does have serious impact on Canadians, on low-income Canadians, disadvantaged Canadians. And you've listed a number of factors which can have an impact. The economic activity rate in Canada, namely, and as well as the inflation possibility. We at the Bank of Canada can react to those various factors, and I've just indicated in my opening remarks that nothing is preordained. The world economy can change. A number of factors can change. Factors including the level of the dollar. Those factors can have an impact on inflation in Canada going forward. And if that is the case, the bank will react in order to reach that target rate. I'm glad you've clarified the term religion or mandate. You can change mandates. Some people change religions, but that's another thing. In the early 1990s, as well as in the early 2000s, the tightening in some views was premature. Rates were lowered and then increased. The same thing was done in early 2000. I'm talking with regard to the Fed funds. And since we're at the start of the 2010s, I'm a bit concerned. I wouldn't want us to, or myself or my successors, say that we went too quickly in 2010, 2011. It's a concern I have. I can assure you that we'll have an appropriate monetary policy for Canadians. Thank you.
Thank you, Mr. Chair, and thank you, Governor Carney, for coming today. I have a number of questions, so I'm going to try to be fairly quick about it. In your opening statement, you talked about the poor relative productivity of our economy. My question to you is that, for your information, there's a bill in front of the House which I'm completely opposed to, which pays through the tax system individuals to go back to their homes, whether they have jobs or not, as graduates. I think it goes completely against the mobility of labor. My question to you, that in terms of productivity, does mobility of labor play a role in the productivity of the Canadian economy?
Thank you, Mr. Wallace, for the question. Yes, flexibility of labor markets are an important aspect of productivity. Flexibility in product markets, openness of trade markets are all factors that influence the productivity growth. Canada does have relatively flexible labor markets. Has been to our advantage. We've seen over the course in the run-up to the recession, the decade in the run-up to the recession, quite large shifts of labor into very productive activities across our country.
The rest of my questions are from the Monetary Policy Report, sure, which I read every time you send it out. I appreciate that. The one question is, I just want to confirm, you indicated in the report, if I'm reading it correctly, that the government stimulus package that has been put out by this government over the last year and a half has made a difference in restarting the economy and has made a difference in our coming out of recession and providing economic growth. Is that what this report tells me?
It's not the theme of the report, Mr. Wallace, but it is certainly fiscal policy has been important, and particularly is important in 2010. The contribution of government, federal and provincial, right, is an important contributor to growth in 2010. We would say that our expectations on fiscal policy thus far have been met. In other words, the contributions have been consistent. I would draw your attention, members' attention, to page 13, where there's a somewhat busy chart, but an instructive chart which shows the levels of activity in the recession and in effect, relative to where their levels were going into the recession. You see a very sharp fall off, for example, in business investment, net exports, less of a contribution. Government expenditure and personal expenditures are the only activities that rise following the start of the recession.
You would also, I'm not going to ask you to agree or not to agree, but maybe you can comment, that the government has done its share. Some people think more or less than it should have in terms of stimulus. But at the end of the day, we need the private sector to come to the table to make sure that this economic recovery is sustainable. Would you agree with that comment?
That's entirely correct. The issue that the recovery will turn on is the full response of the private sector. We've seen quite strong, as I say, housing activity and consumption is held up. What has been lower than the general experience in recessions has been business investment. Our forecast, and this is an important component of our forecast for several reasons, is that we see the recovery in business investment basically from now going forward, and that picks up over the forecast horizon. That's important, obviously, just as a direct contributor to growth, but it's important particularly because it goes back to your productivity point. We have, in terms of the supply side of the economy, the capacity of the economy, rising productivity from very low levels, right, over the course of our forecast horizon through the end of 2012, which is obviously very much dependent on the scale of that business investment.
Just a comment on liquidity. We heard lots during the recession, that business didn't have access to capital. I think you mentioned here from the world perspective it's mixed. Some places have more liquidity than others. What's the Canadian experience at this point in time in terms of availability of capital to the business sector?
The availability of capital it is on the whole it is very strong, but there is still some tightness in the availability for small and medium-sized enterprises. We've seen that the conditions tighten more for small medium-sized enterprises than large enterprises. Large enterprises obviously have the benefit of access to capital markets, which are quite open at this stage, well, we've seen the end of the deterioration in the tightness of credit conditions for small, medium-sized enterprise and just the start of an improvement. There is still a ways to go there. But as a whole, I would characterize, in terms of the recovery and the recovery in business investment, that Canada is one of the least, if not the least, affected countries by this credit tightness that we see globally.
Thank you, Mr. Carney. Now, I have one question that's more of a personal interest of mine. You have a chart in here on page 15 on CPI, total CPI versus core CPI, and I'll probably ask you this question each time. But a number of our programs, particularly for seniors, OAS, and so on, are attached to CPI, so their increases or non-increases change based on that number. I've advocated that maybe there should be a seniors CPI, one that deals with weights things differently, so that would deal with issues that of a higher value to a senior. So driving to and from work doesn't happen that often for many seniors. So the cost of fuel, as in gasoline, shouldn't play as big a role. Can you explain to me? And the blue here, the core is a lot flatter, doesn't change nearly as much as the variances in the total CPI. Can you explain to me briefly what the difference is between the two in terms of weighting and what plays a bigger and lesser role?
Well, to do it briefly, the adjustment for the Canadian core and total CPI is what is removed from total CPI is the most volatile items in that basket. But what is important here is, well, there's less variation in core CPI, and core CPI is the best predictor of future CPI levels. So you see much bigger swings in total CPI. If you look over a longer period, the levels of those prices as they move over time is consistent. So it's core CPI in Canada not uniquely, but it's relatively unusual. It is much more the case here that core is a good predictor of total CPI. You have higher variance, both move in tandem.
I may come back to that too. Thank you.
Thank you, Mr. Wallace. Monsieur Mulcair, s'il vous plaît.
Merci, Monsieur le Président.
Thank you, Mr. Chair. Mr. Carney, good afternoon. Thank you for appearing, and it's always a pleasure to hear your explanations. They are truly pertinent, and for the past few years that we've had the opportunity to sit down with you, and we always appreciate the exactness of your comments. Now, since this is the third spring that we have the opportunity to work with you, it's also an opportunity to measure what has been said in the past with what's going on now. When we see how things have changed, even the Liberal critic has said that you might have been right. So things change. Now, that said, I want to ask you a very specific question on a particular concern of mine, which we've addressed in the past. That's the internalization of the oil sand costs. As you know, we are concerned by the fact that there's an artificial level of American dollars that are coming into the Canadian market because we've never internalized the cost, adopt a user pay principle. And we've left that for future generations, and it has an impact on the Canadian dollar. Last year, you seemed to understand that, but you indicated that it wasn't of your mandate. It was a choice of the government, if I can sum up your statements of last year. But recently, I had the opportunity to see you justify the Minister of Finance when he said he did not want to know anything about what he called a bank tax. And so there are two things at play there. There's the Tobin tax, which is rather a tax on financial services, and a bank tax, which is a bit the straw man that he's raising. But that's a political debate. Now, what I want to ask you about today is to explain the nuance between your refusal last year to give an opinion on the environmental costs of the oil sands and your pleasure, your joy in espousing the Minister of Finance's analysis. For someone who's not in the know, I'm not saying that you're espousing the Minister of Finance's views. I would like you to reassure me about that. Well, very well. There is a difference depending on our responsibilities. The principal motivation of countries that prone or are for a tax on a bank or wholesale funding from banks, it's a financial stability. That's the main motivation. The question for us is whether such a tax is necessarily the best way to achieve our objectives with regard to financial stability. And for various reasons, my response, is no. So there are different motivations at play here. There are environmental issues, but they don't have an impact on financial stability or inflationary pressure in the short term in Canada. And that inflationary pressure is my third question, but I have a second one before that. Because you and I have had the opportunity to speak about inflation. You talked to me about your target, and you're talking about a tightening in order to achieve that target. I think we would have to talk about that. But my second question that I had for you was rather a technical one concerning regulatory structures within the market. During a symposium at the end of November in London, the Liberal critic was in attendance. I was surprised to hear one of the participants, an American who plays an important regulatory role in the UK, believed that the classification of credit ratings should be, and it was quite surprising. It came from someone within the financial market, and it said it should be a state regulatory function. That was during a conference which I attended in Paris in January, and I was surprised in a conversation with Joseph Stiglitz, who shared that perspective. That is, there are aspects of what hit us over the past 2 years that are directly related to the gaps of the credit assessment system. And here you are, a former Goldman Sachs employee, talking with MPs in Parliament, rather than having to face an inquisition by the U.S. Congress. It's because you made a good career choice to come to Canada. But I want to know if you could share with us, or if you agree that that could eventually constitute that the government could regulate credit worthiness in the markets. 1 minute. Well, thank you. In my view, I think it was a mistake to, in fact, give a mandate to our credit rating agency, a number of official mandates to credit rating agencies,
including capital regulations. There's an ability to use ratings which effectively reinforce the franchise of these agencies. And so there is a desire, and also in investment regulations and other things from the official side. So it would be an advantage to remove, to the maximum extent possible, these mandates that reference ratings. Yeah, in order to, but the mandates, the mandated use of ratings, in order to have, if it's going to be private, it should be truly private and only survive, not because by fiat from the public sector, but because of the effectiveness of their opinions, which reinforces the original business model of these entities.
Okay, thank you. Merci. Merci. We'll go now, Mr. Pachetti, of a 5-minute round.
Thank you. Thank you, Mr. Chairman. Thank you, Mr. Carney, for appearing. I want to stick a little bit around that realm. The fact that the economy seems to be doing well globally. We're talking about a global recession recovery. And the last time you were here, we talked a little bit about, what are some of the actions and what are some of the things that we can do to reform the financial system. I think you were quoted in certain areas that you want to see a better collaboration with OSFI and, perhaps taking over some of the responsibilities. The only thing I've been reading about is this bank tax. And that's sort of now being put off. And what is happening on a global end in terms of reform? Is it now going to just go by the wayside, or has there been an improvement? And when I talk about bank tax, I mean, in Canada, isn't there some type of bank tax, or if you want, you can call it insurance, that the banks have to pay to whether it be OSFI or to CDIC? And why is there so much pressure for our banks to pay into a global fund? Can you explain that to me?
Thank you. Thank you for the questions. Very quickly, in terms of the issue, we collaborate very closely with OSFI, the Federal Department of Finance, CDIC, other federal agencies. There's no desire to change any of those relationships, and I just assure the committee that we do work effectively together, and I think to good end. In terms of your last question, which is, yes, banks do pay a deposit insurance premium that is collected by CDIC and invested, and that protects retail depositors. There's some more details, but basically up to $100,000 per account. The issue around the bank tax, if I can explain the motivation, it goes back to previous question. It's to this is the justification, or one of the justifications. There's two justifications to it. First, and I'm quoting the other side, if you will, on this argument. One is to make up for the losses that the state in various countries, for example, the U.S., had for recapitalizing their banks, the direct losses, so they make those up over time. The second one, and obviously that isn't an issue for Canada, as has been pointed out. Second one, though, is to, quote, internalize the externality that comes from wholesale borrowing. So not retail deposits, but wholesale borrowing. And by setting a tax on that, you'd reduce the amount of that, and then you'd set up a fund, because that would be there.
So there would be a global CDIC?
Well, exactly. And this is in the most extreme versions. Now, the issues we have with that are multiple. First off, just let's all stop and think about the prospect of having such a fund and it actually being there when it was needed. First point, global or domestic. Secondly, what would that do to the behavior of the individual institutions and other market participants, knowing that the state was behind, through a fund, these institutions? Thirdly, there are better ways to get this externality. We agree there's an issue with the size of balance sheets. How do you get at it? You get at it by having a simple leverage test, which just restricts the overall size of balance sheets, which we have in Canada. We need one globally. It's one of our top priorities. You get at it by increasing the amount of capital within a business. You get at it by having differential charges for certain types of activities. Notably, if you want to trade derivatives in the dark, that's fine, but it's going to cost you a lot more from capital perspective than it does if you do it on a central clearinghouse exchange. And then the last aspect, again, instead of having a fund globally or domestically over there that probably wouldn't be there when you need it, and I don't want to insult members of the Finance Committee, but sometimes taxes aren't always ring-fenced for their uses, that you have the fund embedded in the actual institution through contingent capital, and that is an example, to go back to the first point on OSFI and collaboration, where we are working in extremely close collaboration with OSFI in developing a concrete proposal which has some support internationally, lots of details to be worked out.
So that would be my question, I guess. So why? So just to go back in reverse, so if the bank tax is not acceptable, but why not sell our advantages, institutions that the previous Liberal government would have been put into place, and sell that internationally? And
yes.
so what is the failure there?
No, I don't think there's
the reform.
Yeah, I'm conscious of your time, and that is the strategy, first and foremost. The core of this is we need more and better capital. We need leverage ratios on an international scale, as we have in Canada. We also need to make some other measures, and we can talk about them if the committee is interested. But I would say that...
What's holding it up?
We are making progress on this. It's going to be very intensive between now and the November summit in Korea, which is the target for having this package together. And we're available anytime to go into detail on these issues if the committee is interested. But I would say that the success of this past weekend was to put the distraction of the bank tax off to the side and reestablish the focus on exactly what you're talking about.
But is the philosophy still to recover past losses, or is it to go forward?
The most ambitious variant of that tax is to build up a fund to anticipate future losses, which in our view is unacceptable, because the point is the losses stay in the sector recapitalizes itself, and you create tremendous moral hazard by setting up this pot, and finally that pot probably isn't going to be there in a pinch.
Okay, thank you. Monsieur Carrier, s'il vous plaît.
Merci.
Thank you. Good afternoon, Mr. Carney. It's a pleasure to see you again. My first question is concerning the tax on bank transactions. I know you agree with the Minister of Finance's opinion. You're not in favor of such a tax. The International Monetary Fund does recommend that to G20 countries. However, the president of the IMF has indicated that if it's combined with the stricter regulations within the financial services industry, it could be an advantage. So I wanted to know the reasons why you're opposed to such a tax. Do you believe it's because we already have a sufficiently strict regulation, therefore it would not be necessary? So do you believe we need more regulation for countries that want to improve their situations? So I'll let you expound on that. Thank you, Mr. Carrier. Just a point of clarification. You're talking about the same issue raised by Mr. Pachetti and Mr. Mulcair, or are you talking about a Tobin tax? It's rather a Tobin tax, yes, type. Unfortunately, the document that we received from the International Monetary Fund is only in English. It's their fault. It's not anything to do with the Bank of Canada. But I must say that the International Monetary Fund's counsel, with regard to Tobin tax, is to say no.
Financial transaction tax, that's a Tobin tax, is not the best instrument for these purposes. It is not the best way to finance a resolution mechanism. It's not focused on core sources of financial instability, and its real burden will fall largely on final consumers than the earnings of the financial sector. The advice that we received very clearly with respect to a financial transaction tax from the fund, a Tobin tax, was don't do it. And there was no serious discussion of implementing that. And as you probably know, comme vous le savez sûrement.
And as you probably know, it would be impossible to implement a Tobin tax without the agreement of all major countries. Very well. I'd like to move on to another issue. I noticed in your opening remarks that you spoke about the increase in GDP. That increase will lower. You are predicting 3.7% in 2010, 3.1% in 2011, and 1.9% in 2012. I wanted to know, in terms of comparisons with other economies, are we faring similarly to other countries in terms of GDP, in terms of the slowing growth of the GDP? Is that specific to Canada or generalized? Thank you for your question. Well, that's an important issue. First of all, the growth rate in Canada, according to the World Bank, and there are similar figures to the Bank of Canada's, but the same message is coming across. This year, our projection indicates that the growth rate in Canada will be the strongest among G7 countries. But afterwards, and as you've indicated, the growth rate will decline progressively. For instance, in 2012, our rate of growth, according to the bank, will be the same as the potential rate of growth in Canada. And that's the reason. And in comparison, the potential growth rate of the Canadian economy, in our view, will be 1.9%, compared to a potential growth rate in the U.S. of, in our view again, approximately 2.4 or 2.5%. And that's because of two factors: demographics and productivity. 30 seconds. Is that clear enough? Yeah. To follow up, is that related to the growth rate in the U.S.? We're heavily dependent on them, and since their economy will slow down, we will slow down as well?
The slowing in the United States is a factor, but it's also we reach our rate of potential growth. So the economy is equilibrated, and if we want to grow faster, unlikely we'll improve our demographic profile, so it's a question of productivity, and our judgment is that productivity growth, given where investment has been, would be about 1.4% per annum by 2012. And so that is the key regulator on the rate of growth in this economy.
Okay, thank you. Merci. Go to Mr. Hebert, please.
Thank you, Mr. Carney, for being here with us. As I was reviewing your most recent report, I noticed on page 17, Table 2, the change that has occurred between the Bank of Canada's overnight rate and the prime rate. It's been some time since the historical gap between the two was 1.75%. And I think we can all appreciate, as Canadians can mostly appreciate, the increase that occurred, for those that are in variable rates, experienced back in December of 2008, the increase from 1.75 to 2%. I'd be interested in knowing your perspective as to the implications of this change between this historical gap, and what was the basis for the change, to which I can speculate. My real question has to do with whether or not there should be action taken to encourage financial institutions to return to that 1.75 gap, and what implications that would have for Canadians.
Well, thanks for the question. I would say, first off, in terms of the implications for Canadians and for monetary policy, I mean, we take this into account. We take the spread between our rates and the rates that Canadians are paying. So whether it's on prime borrowings or on 5-year posted, on mortgage rates, not just what's posted, which is what is reported, but what they're actually paying. So you see, and if you look at the chart as you have, for example, on variable rate mortgages, those continue to come down. Actual variable rate mortgage payments continue to come down. The discounts to posted 5-year mortgages and the discounts to posted prime continued, re-emerged over that time. So the effective rates that Canadians have been paying have come down over that period of time, not for all Canadians. And the likelihood of somebody writing a letter to you or to me, and I get plenty of these letters, is a product of whether they're in that camp, partially. So that your question is, what do we do about it? We take it into account. We care about what the rate Canadians are actually getting and what that means for economic activity and ultimately inflation. Well, I'll leave it at that and let you follow up.
Wasn't the basis of the change the worldwide economic recession that was experienced back in 2008-09? And since that has resolved itself somewhat, would it not be reasonable for Canadians to expect the historical gap to return?
Well, I think there's two things. There's one, if I may. I mean, one is the funding costs of banks and the increase of the spread. Ultimately, it's a product of the recession, but where bank funding costs and bank spreads went in shorter-term markets. And if you look at, for example, the spread between, I'm going to get technical, but it is the Finance Committee, the spread between CDOR rates and the overnight OIS rate, so where the market expects our interest rate to be and where banks are borrowing in the interbank market, those have not returned to historic norms. The spread has, the stability is returned to that market, which is welcome, and that means that on a level basis, there's less need for liquidity, but they haven't returned to historic norms. Ultimately, these are markets, and one has to be quite careful about dictating market prices, I would suggest. And from our perspective, the market price that we set is the overnight cost of money, and we take into account where markets are going from there in determining where that level should be.
1 minute.
Changing the subject just a little bit, in your remarks and also in the summary of your report and in the report itself, you make the statement that on the downside, the combination of the persistent strength of the Canadian dollar and Canada's poor relative productivity performance. When you refer to our poor relative productivity, who are you comparing us to?
We are, well, it's a pretty long list, actually, unfortunately. I would draw your attention to a chart on page 21. It's chart 19. In that chart, the relevant line is unit labor costs. In Canada and the United States, U.S. Unit labor costs in Canada in U.S. dollars, which is the green one, going up, and in the blue, United States in U.S. dollars. And you see the gap that opens up. That is a product of partially the exchange rate, but it is also the product of the fact that unit labor costs in the United States have been falling. They've been falling because productivity growth has been so high relative to wage growth, and they've continued to rise in Canada despite large increases in spare capacity, and that's a product of flat to negative productivity in Canada. So I'm afraid that vis-a-vis our largest trading partner, the story is not good, and there is a longer list, not quite as impressive relative to Canada, that have performed on productivity.
Okay, thank you. Go back to Mr. McCallum, please.
Thank you. I certainly agree with what I think you said, that a bank tax that created a fund for future financial crises would constitute moral hazard, and that funds built up within banks based on their own capital are better. I think that's what you said. But I have a question about too big to fail. I read in the latest Economist magazine where they were claiming that one justification for a bank tax was that the big banks get a lower interest rate because they are perceived to be too big to fail, and that could justify a tax. I guess partly I'd like to ask if you agree with that point of view. But more importantly, the Economist magazine went on to say that a better solution is to do something about the too big to fail challenge. And I know that is a challenge. I know people are working on that. So my question to you is, do you think there is some sort of a resolution in sight that means can be found so that large institutions may no longer be seen as too big to fail?
Yes, absolutely. That you put your finger on exactly the right issue. The issue with, just very briefly, on why the tax, in our view, doesn't get to this externality issue is that by creating this fund, or one of the issues, there's many, but one of the issues, you're creating a fund, and so I, as a borrower of the bonds, or as a lender, buyer of the bonds of this financial institution that ultimately benefits from the fund, why do I have, why is that not a quasi-sovereign obligation, given that's what moral hazard means, obviously, and certainly as the counterparties and other people in the transaction. So what do you do about it? What I would say is that would be the question that I would encourage members and others to, judge financial reforms by the extent to which, in an efficient way, they address this issue. So are we building a system where large institutions can fail without impacting other institutions and really impacting the real economy? That's the issue. Right. And so what do you do about it? Well, that's part of it. You change market infrastructure, so you have an ability to remove, if an institution fails, the market continues to function. So we're doing that with repo transactions in Canada, along with the industry, through a central counterparty. There's a major G20 initiative that's relevant to Canada on OTC derivatives and moving standardized derivatives onto central clearing. That's incredibly important for exactly this reason. The next thing you do is you make sure your supervisors, OSFI, CDIC, have all the powers, appropriate powers, to resolve an institution if they get it in trouble. And that was one of the failings in the United States, is they didn't have effective resolution powers for big proportions of their financial sector, important, including investment banks and insurance companies, and you can think of who we're talking about. And then the other thing we say you do is, and just to be clear, is to have contingent capital or contingent capital attributes, we and others, OSFI particularly. And just to be clear what we mean there, it's not core capital, it's elements of the financing of the institution, subordinated debt, and maybe even senior debt, that then converts into core capital if the institution gets in trouble. And what it does is it converts into equity. It dilutes existing equity holders, but it recapitalizes the institution from itself. And there is a variety of ways to do that, but I think it's very promising because it bears the costs within the sector and ensures that somebody who's a going concern can, or is about to become a gone concern, if you will, can continue to function because they're recapitalized through their credit staff.
Well, thank you. I agree with everything you said on that. But I think it's also true that, you know, we certainly weren't at that phase when they allowed Lehman Brothers, for example, to fail and the system practically disintegrated or ran into huge trouble. So do you think sufficient progress is made that if we had another crisis, say 5 years from now, we would have advanced to the point where such institutions could be allowed to fail without doing huge damage?
Yeah, that's the test. And if you're asking me right now, has sufficient progress been made? The answer is no. You know, these are issues that are being discussed. We need to come to agreement on them, but we have not yet come to agreement on them. The key date for this year is the November summit in Korea, and the run-up to that. And all I can say is that we, the superintendent and the Department of Finance, are working very hard to make progress on these issues.
Thank you.
Thank you. Monsieur Jean Madrou, s'il vous plaît.
Merci, Monsieur le Président. Bonjour.
Thank you, Mr. Chair. Welcome, Mr. Carney. I would like to come back to the positive effects, according to your latest report, of the fiscal stimulus measures that were put in place to make it through the difficult economic times. So I'd like to come back to the positive effects, according to what you've stated, of the stimulus measures to make it through the latest recession. How do you believe those measures were beneficial to the Canadian economy? Well, I perhaps could be more specific in terms of the impact of the monetary policy and the easing of that policy since early 2008. Since that time, the Bank of Canada has reduced, and quickly so, its overnight rate. And in April 2009, we lowered it to its lowest level possible, and we have renewed our conditional commitment. I'm certain that our monetary policy has had an impact and continues to have a major impact on our economy. I could perhaps refer to my responses to questions to Mr. Wallace with regard to the impact of federal budget federal and provincial budget initiatives in Canada. Now, your projection indicates that the recovery might not be as quick in the next quarters. Do you believe that the measures put forward by the Bank of Canada, as well as those of the Government of Canada, should be continued or at least maintained for a longer period in the event that the economy doesn't recover as quickly as we are hoping for? The economy is more vigorous than what you had forecast last year, and we do hope that will be the case, despite your statements contained in the report that you believe the growth rate will be lower. Do you believe the measures that you've implemented and that you've already announced, the removal of the conditional commitment? Now, could you perhaps come back to the earlier position if the recovery were stalled? Well, first of all, with regard to our economic outlook for Canada, we've underscored the fact that there was likely an increase in household spending, and that has had a major impact on the latest quarter and the first quarter of this year. Now, following that, there will be a progressive a slowdown of economic activity in Canada. Now, as for our policy, our monetary policy, the objective is clear. That is to reach our target inflation rate, which is 2% of total CPI. The banks will manage our policy in order to achieve that target. And, of course, there are risks, whether upward or downward. That might have an impact on increase in the activity rate in Canada and inflationary outlook. And the bank will respond in an appropriate manner to those impacts. Thank you.
Thank you, Mr. Chairman. I think on a few occasions on your opening remarks, you mentioned the word or the words monetary stimulus. And I think on your second to last point, you say we should lessen the degree of monetary stimulus. But what would be the definition, or what would be an example of monetary stimulus that the Bank of Canada would?
Thank you. Thank you for the question. This is a very important point. And if you'll permit me, sir, to go back to this time last year, when we reached the zero lower bound, or the effective zero lower bound, 25 basis points. For technical reasons, we couldn't see the interest rate going any lower than that. So the question, and we felt that given the level of activity abroad in Canada and the perspectives for inflation, in order to achieve our inflation target, we needed more monetary stimulus. At that point, we were faced with a choice. Other central banks have been faced with this choice. The first step that they had taken was to quantitative ease, print money colloquially, or to credit ease, which was to purchase securities. We provided a policy. First off, we wanted to have a policy which was rooted in principles, that was transparent, and we were fortunate that we were able to put that out and come to this committee immediately after and explain ourselves. And we saw a third option. We have those two options, and we continue to have those two options if they would be needed, but the third option was to provide extraordinary guidance on the path of interest rates. And so that's why we gave the conditional commitment. And so your point, what did we get as monetary stimulus out of that? What we got was a movement in the short end of the yield curve from the overnight rate out to the end of June 2010, a movement down. And over the course of the year, as we've reiterated that commitment, that bit of the yield curve has been anchored, and those are important yields for a variety of prices which have eased financial conditions in Canada, including for prime rate borrowings discussed earlier. So by removing that commitment, even though the amount of time that was left in that commitment was relatively short, it gave a corresponding adjustment to those expectations, which removed some of the monetary stimulus was there. So that was an unconventional policy. It was done for extraordinary times. Our message is that those extraordinary times, not difficult times, have passed, but extraordinary times have passed or are passing, and so it was appropriate to remove that. And that was the monetary stimulus we'd taken out.
But if we use the example of quantitative easing, I remember when you brought that up, and that's what I thought you were referring to in your monetary stimulus, but my understanding is that you never used the quantitative easing.
Yeah.
What was the second one? Credit?
Credit easing, which, for example, the Federal Reserve would bid, but also the Bank of England, they would directly purchase bonds, credit securities in markets that were particularly distressed as in an effort to get those markets restarted. The most dramatic example, if you will, or largest example of that is the Fed's purchase of a very large number of mortgage-backed securities in the United States.
So the fact that you never actually used them is still considered to be lessening the degree of monetary stimulus?
No, what I meant was what we've done to lessen the monetary stimulus in my remarks at the start, to be absolutely clear, is that the decision taken last Tuesday to remove the conditional commitment was lessening monetary stimulus in Canada.
Okay. And a quick question is something entirely different. We talk about growth, and with the numbers being over 3.7, I think it is. Isn't the growth coming at that higher rate just automatically give you inflation?
Well, no, it's a function of the capacity of the economy, the rate of growth, the capacity of the economy, where we are relative to the potential of the economy. It's a function of other factors as well, the exchange rate pass-through, other things such as that. But we have...
But when it happens in such a short frame...
In a summary measure, in a summary basis, we have an output gap even after that surge in growth in the first quarter, which fourth of last year, first of this year, which is still 2%. So we still have a fair degree of slack in the economy. These are not precise measures, but we've been pretty conservative in our estimate of that.
The reason I'm asking is because if the growth is so quick and it's such a short time frame, wouldn't it be just for specific items, products, sectors that are already equipped and then just shoot up, and that's what would cause inflation? But you're saying it's an overall...
There's a lot of slack in the economy. That some of that slack starting to be taken up, and in fact, this is typical growth in many respects to a recovery. The pace of the recovery as a whole, though, given the severity of the recession, which was short but sharp, is not back at historic averages. Our forecast not back at historic averages. Variety of reasons for that, and as a general factor, early in recoveries, because of lags in labor markets, lots of other factors, there tends to be a slower recovery in the pace of inflation. And well, we can talk about the specifics of the forecast if we have time.
Okay, thank you. Thank you.
We'll go to Ms. Block, please.
Thank you very much, Mr. Chair, and thank you for being here, Mr. Carney. We've heard numerous times how important it is to keep Canada competitive. And we've seen that Canada has gone a long way to do just that, especially in relation to business taxes. KPMG's recent competitive alternative study showed we now hold a business cost advantage over the United States. They also noted that Canada, though, cannot rest on its laurels on lower business taxes. In fact, let me quote them. Canada must continue to present a clear value proposition to businesses in other areas in order to maintain its attractiveness for international firms. They also explained this by noting that Canada's big rivals are no longer developed countries like the U.S., but also emerging low-cost economies such as Mexico. And this would appear to be a sentiment that you agree with. In fact, I'd just like to quote a speech that you gave this past March. Whatever the combination of reasons behind Canada's poor productivity record, there are several avenues available to policymakers to encourage sustainable longer-run growth. It is important to acknowledge that successive governments have taken many steps in the right direction. Corporate tax competitiveness, particularly for new investment, has improved markedly over the past decade and is now among the most attractive in the industrialized world. Canada has also actively pursued trade openness through new agreements and unilateral tariff reductions. Staying the course in these regards is likely the single most important contribution of the public sector. Can you expand on why staying the course on Canada's business competitiveness is that important?
Thank you for the question. Thank you for reading my speech. Put you in a very select company there. Exactly. No, there are a variety of factors. One of the points of that speech is that a variety of measures have been taken by a variety of governments over a number of years that have considerably improved the business environment in Canada. That runs the gamut from investments in primary research, improvements in labor market and other flexibilities, and infrastructure investment, and importantly, as you referenced in the point of your question, a fairly dramatic turnaround in business taxation in the country, and very importantly, and there's still some final measures that are coming through on this at the provincial level, on the marginal effective tax rates on investment in the country, and so we've seen a big move prospectively in terms of both corporate income tax competitiveness and the competitiveness of new investment with the full implementation of these measures. So yes, that is important to the response. One of the other messages of the speech, I think, is that there will continue to be governments requirements of governments to make these investments going forward, but at its core, there is a challenge for the private sector to take full advantage of this business environment, as we would expect them to do, and is now consistent with our forecast in terms of an uptick in investment, but not just take advantage of the business environment, but also maybe less as a competitive threat from emerging markets, but as an opportunity to develop those markets, reflecting the relative shift in the weight of growth between the advanced and emerging economies.
About 30 seconds, if you want. Okay. Thank you, Ms. Block. Monsieur Mulcair, s'il vous plaît.
Merci, Monsieur le Président.
Thank you, Mr. Chair. I had given pre-notice to Mr. Carney with regard to the other issue, that is inflation. I must admit, Mr. Carney, you impress me because your talent as a teacher is impressive, especially when you talk about quantitative easing. It was basically printing money. That's basically the most frank explanation I've heard to date. Now, that said, there is an old saw in economy that inflation is caused when there's too much money running around, too few goods, and now there will be money to be absorbed, and as well as a monster deficit and debt. I don't want to talk about the issue of the war in Iraq, but even before the current crisis, the war in Iraq had cost $1,500 billion US, and that debt will have to be resolved, like it was done after the Vietnam War. Inflation that was seen following the Vietnam War wasn't foreign to the fact that that debt had to be reimbursed, and what better way to reimburse was for the government to print more money that's worth less. I've taken good note of your 2% target rate, which is unchanged, and as well I take good note of the stimulus measures will be decreasing, although you've said that nothing has been preordained, as you've indicated. But perhaps you could share with us what you see to be the actual possibility of inflation, as like we've seen in the late 70s and in the 80s. and perhaps you could tie that in with an excellent initiative taken by the Conservative government, and you heard me well. When the Minister of Finance gave a warning to those buying their first homes not to go out on a limb because very low mortgage interest rates you can get caught up in them, especially as we've seen in the early 80s and with interest rates that rose up to 20%. Well, thank you for your question. It's a complex one, but very relevant given the current economic situation. Allow me, I'd like to answer in English.
The issue that you're identifying, and I appreciate your acknowledgement of our inflation target and the discipline that imposes on us in terms of the management of our monetary policy, is such that this easy out on the fiscal side, if you will, or more broadly, is not likely to happen. We have to respond appropriately, anticipating inflationary pressures in this economy, so that one is not in a situation where there's a sharp increase in interest rates down the road, an overshoot, if you will, in the monetary response because of a timidity early on. The intent of major monetary authorities around the world is to follow similar policies, and their intent is to do that, and I have confidence that they will. Whatever they do, though, we have the ability to control the rate of inflation in Canada. Nous sommes maîtres chez nous en ce qui concerne.
We're masters here in Canada with regard to inflation.
The necessary steps. I would say finally that the solution to this, and this is slightly a gratuitous comment, but it's something that has been discussed. The solution to these debt issues is not, in other countries, in our opinion, is not to change the rate of inflation, to try to target a higher level of inflation in order to inflate away the debt in a sort of orderly fashion. It's extremely difficult to move from a low to a higher rate of inflation, and I think that view is shared more widely. Thank you.
Okay. Thank you, Mr. Mulcair. We'll go now to Mr. Pachetti again, please.
Thank you, Mr. Chairman. Just on a different subject, debt. So just address debt. I think I've looked, well, not think, but I'm looking at page 16 and 17. So maybe talk a little bit about the difference between individual debt and business debt. I think the charts explain, chart 15 explains, why you feel the business debt is sort of leveled off, but individual debt seems to be being on an increase. Not to be facetious, but I guess I have two questions. Is why would you care about people's debt or household debt or debt increasing? Shouldn't that be the problem of the lenders? Or do you care, I mean, perhaps a strong word, but is your concern or your mandate more to deal with the lenders or the actual individuals that are doing the lending?
Well, we care, and we do care about people's debt. We care for two reasons. We're here to discuss the monetary policy report, so I'll focus on that aspect. But there's also financial stability concern. But with respect to monetary policy, our concern is the rates on debt, the take-up on debt, is one of the factors that obviously influence, in the case of households, residential investment, home buying, renovation, etc., and consumption. And so it's indicative of the level of activity and the ease of that activity. What you've seen is, not surprisingly, and I should say as well, that it's obviously, and this goes back to a previous question of Mr. Hubert, was the impact of that on economic activity and how we look through from our policy rate to the effective borrowing rate of households and businesses. What's it going to do to activity? What will it then do as part of one of many factors on inflation? What we've seen in household debt borrowing costs, more specifically in recent weeks, is that fixed-rate mortgage costs have gone up in recent weeks, and that's a product of increases in the underlying funding costs of banks on a term basis, so on a fixed-rate basis, at 5 years, which is the 5-year fixed rate, and that's basically what we've seen is a rise in government yields since our last report. Generally, that's consistent with an improvement in global economy and a slight increase in the funding costs of banks above those government yields. So the combination of those two have raised the cost of debt.
Sorry to interrupt. So
yep, no, that's the end.
No, I understand. So you're worried about debt and the effect on monetary policy and the way it's going to affect. If I am a financial institution and it doesn't really matter to me what the Bank of Canada says, and I decide to lend money anyway, is that a problem that you have in terms of your policy, or are the banks going to lend money irregardless? Because in Canada, they have insurance; they can always collect from CHMC. Do the banks really care that the home prices are going to go up? Is there? I guess where I'm going with this is there a danger that we can copy what went on in the States?
Yeah.
Well,
it goes back to, in some respects, this goes back to the question of Mr. McCallum earlier about the risk of household spending being higher than expected, and our expectation is that there is going to be a slowdown in the rate of debt accumulation of households, most notably through the mortgage side and the residential side. But if that doesn't transpire, yes, it's an issue. It's an issue for us, all things being equal, because it will be the impact that has on activity and inflation. Now, all other things aren't equal ever, so we have to take everything into account. But we do look at the momentum that is in housing markets and in consumption. Yes.
So in reverse, will the bank stop lending because of your because of the warnings that you
well, there's a price signal that's sent with higher borrowing costs, and we see the start of higher borrowing costs in fixed rate mortgages. On the margin, some people will not take out a mortgage at those levels, or not as large a mortgage at those levels, and that will slow it. It's not stopping lending. It's a reaction to supply and demand.
Slow down. Thank you.
Thank you.
Thank you. Monsieur Payet, s'il vous plaît.
Oui.
Yes, you were right to say earlier that if ever there was an international tax on financial services, that we shouldn't leave that up to a government, because the money might not appear when we most need it. And both parties here have dipped into such funds. It is often said, and you've mentioned monetary policy and instruments of monetary policy. Sometimes we get the impression that the Government of Canada has never intervened with charter banks. But as a Governor of the Bank of Canada, you have increased a number of things, including CMHC securities. Now that's a mortgage portfolio. Now, are there no problems there? Is evaluation done properly, and there won't be a backlash in the short term? That's my first question. I have another one after that. A little point of clarification. Since the start of the financial crisis, there's been liquidity problems in the short term in financial institutions, including Canadian financial institutions. Consequently, the Bank of Canada provided liquidity to banks. But we did so in a way, these are securitized loans, securitized with bonds and such as CMHC. CMHC, thank you. And each time we've done so, we've given less money than the level of bond. So we're protected there. And in financial speak, the haircut were quite drastic. Now, as for the values of, in terms of liquidity, well, at the high point of the crisis, the amount of liquidities, well, 50 billion approximately was, and at the high point on the part of the Bank of Canada, not from the Government of Canada, but at the high point, we injected some $40 billion, and now the amount is approximately $22 or $23 billion. And between now and the end of July, at the end of July of this year, that the amount of special liquidity will have gone down to zero. We'll put an end to that. And another financial policy instrument is moral persuasion. Moral persuasion of the Governor of the Bank of Canada. Last year, the fact that you announced that you would be announcing something in the future, that's a form of instrument. And it was a way of telling banks that now you can go ahead. And we've seen mortgage rates have been increasing since that time. And there's been a tightening for SMEs. We talked about that earlier. I would like to tie in with that. You're saying that there's availability of capital for SMEs. However, and I come back to what I've said at the start, when projects were launched through mortgage loans, and SMEs were be able to recover and needed capitals to and to make investments at a time when no loan guarantees were provided by the Government of Canada. The rates now are rising, and the rates in all sense of the term. Now, is that too much tightening? Well, first of all, the increase in mortgage rates, fixed-term mortgage rates, well, those increases began before our statement. And as I've indicated, that was the result of an increase in banks' financing costs. And the main reason for that was an increase in government yields. But there's a simple fact. With the ongoing recovery in the Canadian economy, a number of rate increases, whether it be in the mortgage sector or the prime rates, could increase, and that's normal because levels are still at an exceptional stage, and that's the point where we're at now. The rates are still very low, and so let's be cautious now and be careful with your affairs.
Take the next round as the chair. Mr. Carney, I did want to talk to you about the dollar, and you've got you discussed that in your report on page 19, 20, 21. With respect to the dollar, I mean, a common perception was, especially when the dollar rapidly appreciated in recent times, was it was driven by petroleum prices, driven by the price of crude mainly. But you discuss here energy prices, you talk about prices for non-energy commodities increasing, and then you talk about global credit conditions. I think obviously the state of the U.S. dollar as well would have an impact there. In terms of, I mean, is it your view that petroleum or the price of crude is not as large an influence on the price of dollar as it was, say, perhaps a year or two ago?
Yes. Well, one hesitates to be too precise about what about short-term movements in currencies, and so I will not be. The level of our dollar is a product of numerous factors: our relative economic performance, fiscal position, relative fiscal position, the terms of trade, which is much broader than, as you're suggesting, Chair, just the price of oil. It does bear reminding that natural gas exports of this country are larger or equal, at least, in fact, larger, depending on the day price of natural gas, than our oil exports. And it is a huge source of investment in this economy as well. So it's a variety of factors on the terms of trade. I would say that persistent strength in the Canadian dollar is a risk, an important. We've only identified two major downside risks to the Canadian outlook, and the dollar is the first. And so it's something we watch closely, and could have an important influence on both economic activity and the outlook for inflation, and the bank will set policy appropriately in those circumstances.
So it's one of two, and the second factor is the concern about economic activity in the U.S., if I'm correct.
The outlook in the United States. The United States remains a reserve currency at a minimum, and the outlook of the United States in relative terms globally amongst industrialized countries is improving, and certainly, and we've highlighted in the report, and the importance of the handoff, if you will, to the private sector later this year and into 2011 in the United States. It's a substantial acceleration in private activity that is consistent with our projection. Remains to be seen how well that will progress, but there has been a strengthening of the U.S. economy, and in relative terms, I think that the U.S. economy is doing better than had been expected by many participants in recent months.
On page 21, you do talk about, or you sort of mention a concern about U.S. economic activity and then the higher value assumed for the Canadian dollar.
Yes.
In the past, I think both you and the finance minister have made an effort to, in a sense, talk down the dollar to dampen some of the, especially when it was rapidly appreciating. I mean, that works for a time. I think that sort of works probably less effective over time. Is there any concern about lesser tools available to you if the dollar continues to appreciate?
Thank you. Markets sometimes overshoot, and we should be conscious of that. For those reasons, the bank, in agreement with the Minister of Finance, have additional tools to address those situations, and no one should be under any illusions that we wouldn't use them if it were not appropriate.
Okay. And one final question: there's obviously a lot of discussion both in this country and around the world about too big to fail. If it's too big to fail, it's too big. There's some of my friends even on this committee who suggest that in the past policy decisions were rightly made by not allowing certain institutions to merge or to grow larger. Yet my contention is that perhaps it's not the size of an institution like a bank. Perhaps it's more to do with the capital requirements or the reserves. So I'm wondering if you have a perspective with respect to, it's not the size perhaps of a financial institution, but it is in fact the level of reserves or capital requirements that ensure the stability of that institution over time.
Yeah, well, it's that is true in that the higher capital, better liquidity management, higher liquidity actually carried on the books. Those are all factors that will reduce the probability of failure of individual institutions. Collectively, will improve the resilience of the system. The other factor, which is important to consider, is the interconnectedness of institutions. Do they hold each other's bonds? Are they big counterparties with each other's? How related are institutions? Because the contagion effect of one institution going down, and I would, I guess, point out you know this, but it bears remembering that Bear Stearns was the 6th largest investment bank in the United States. So not a big investment bank, but the 6th largest. And it was the determination of the U.S. authorities that it was too big, or rather too interconnected, to fail, which is why they took steps and to engineer an orderly rescue of that firm. And I must say, based on what I know and understand of the situation and understood at the time, that that was the right decision. So one has to attack as well these interconnections as part of financial reform, so that an individual institution can be separated, if you will, from the system if they have failed.
Okay. Thank you. Mr. McCallum, please.
Yeah, if I could just return to the tax issue, the bank tax issue, or the transactions tax for a moment. I think I've sort of indicated my position, but I've heard numbers like several hundred billions of dollars per year could be earned from a small tax on transactions, whether foreign exchange transactions or somehow a broader set of transactions. And I guess I've been thinking about this, and the implication seems to be this would be somehow painless. And my question has to do with two things. One, the reaction of financial institutions, and two, the incidents. And on the reaction, having worked for a bank and you having worked for something similar,
Who did you work for?
my thought is that there would be huge change in trading patterns, so that instead of trading volumes reducing 40%, for all I know it might be 90%, or I don't know what it would be, but it seems to me one can't just calculate revenues on the basis of existing trading patterns pre-tax. That's the first question. And second, I think when you're talking about hundreds of billions of dollars, someone has to pay. And I can imagine people going to the United States on holiday, or people buying mortgages, or people getting loans, or is it somehow going to be limited to speculators paying? So I'd like to ask you what you think on these two subjects of incidents and the reaction of financial institutions, which would affect the revenue.
Yeah, well, I think you're absolutely right in that on both points, which is that, and you agree with me earlier, so now we're even. But the reaction, particularly, I think one of the reactions we worry about is maybe not just the level of activity. I mean, these calculations assume that it's the same level of activity, and you strip out a cost. There will be a reaction to it, which in many respects should be the point. I mean, the issue should be the externality that comes from that activity. But the other reaction that concerns us is the practicality of having everybody sign up to the same transaction tax, because the one reaction you can expect is that the activity will migrate to those jurisdictions that don't tax the transactions, right. And so the incidents it'll be greatly reduce the proceeds. Now, vis-a-vis the incidents, it is likely to fall on the end borrower very clearly, not just in terms of, I mean, obviously importantly, individuals who are doing foreign exchange transactions for normal activities like going across the border to visit friends and family, but commercial borrowers and households. So it should be passed net through. And that is the conclusion with respect to a Tobin tax, or a financial transaction tax of the IMF. And that's the one tax they didn't recommend to the G20 this past weekend. There is a more general point, though, if I may, which is that, well, we are of the view that higher capital is required for the system, and it is. Globally, the system was undercapitalized. That capital has to earn a return, as well, as you well know, and the effect of higher capital, tighter liquidity standards, will be some increase in the cost of capital, not just to the institution itself, but to the end borrowers from those institutions. But that is can be seen through the longer spectrum of wild swings in the level of capital, huge fiscal costs that are incurred by all of us to address these crisis situations, and a greater level of stability. And also, finally, to the fact that in the judgment, or the judgment that in the years just prior to the crisis, the cost of capital, the cost of borrowing, because we had
Okay, I'm told I have 30 seconds.
a bubble, it was too low.
I just want to get one last quick question.
Yeah.
IMF, I think, has gone back to the drawing board. Are they going to come forward with alternative proposals on such taxes?
Well, yes. Well, they would have to, certainly. And I think the strong point that we made, and we made a number of points, and there was a pretty strong agreement. But one of the core things is the core agenda here, as we've been talking a bit, is capital, liquidity, interconnectedness, and we have to make progress on that core agenda. You should hold us to account to make progress on that core agenda by November. And then once you see what those measures are, what the expected impact would be, then the question is more required? And so also for the IMF, if you're thinking about layering a tax on top, and not very many people are, you better have calculated the net impact of extra capital, extra liquidity, other measures that are put on the financial sector and ultimately pass through to the real economy.
Thank you.
Thank you. We'll go to Mr. Menzies now.
Thank you, Mr. Chair, and I appreciate Governor Carney being here today. We appreciate your articulate answers, and you usually get a grilling when you come here, so I'm going to change the channel a little bit, and I'm going to ask people to think back to where we were 12 months or 18 months ago. And we need to recognize the role that you and your staff or your deputies played, as well as the finance minister, and where we could have been. And I still haven't got a grasp of all the role that you played, that the bank played. I pretty much understand the role that our finance minister played in keeping Canada stable and in making some of the right decisions. And I know you were party to that, and I don't know how much of that you can share with us, but the role that we've played, most Canadians don't understand the role that we've played, and I think it was exemplified this weekend. The fact that with your assistance, and the finance minister was able to turn things around at the G8 and G20 discussions that would have been hugely damning to the Canadian taxpayers, because I think we all know there's only one taxpayer in this country, and that's you and I. And any tax on a financial institution would be quickly passed on to us. And just a quick comment on that. And then one quick explanation, if you could. We've had one individual from this committee stand up in question period and ask about the home renovation tax credit and why people that didn't pay taxes didn't get any money. Can you maybe just very quickly explain how a tax credit works?
He should know.
Okay. Well, first off, thank you for those kind words. The depths of the crisis, there were some very difficult decisions that did have to be taken, certainly internationally, that I think Canada, and in Canada, we were able, because of our relatively better position, I think, to assist. Well, the history will ultimately be written, but assist in helping others to make the right decisions, if you will, internationally. And I think importantly, in October of 2008, to get agreement at the G7 level, which really turned it around, that we would take some difficult decisions in terms of providing more explicit support for institutions in terms of liquidity and backstopping, to put a floor under the crisis. And I think it was helpful in that situation for the Minister of Finance, supported by me, to say that even though we don't have to, we will, and to help others represent it. And we clearly didn't, but it helped others to represent that they didn't necessarily have to as well, because we, like Canada, didn't have to do it, but as a whole, that table needed to do it, and we absolutely did need to do it, and we had to do it immediately at that point. So that was helpful, and crisis helped forge relationships, and the relationships that we built up in the G8 and G20 have helped to advance the reform process, and certainly the performance of the Canadian sector has helped advance things. And finally, I would say that it's up to us to provide some intellectual leadership on some issues at the G20 to move things forward, because the system obviously needs dramatic change. With respect to the home renovation tax credit, it was a sort of Men in Black incident as I moved over from the Department of Finance to the bank, and it was reprogrammed, and I'm afraid I've forgotten exactly how a tax credit works, so I'm not going to be able to help you out.
Okay.
We're able to
Pretty good answer there, Mr. Carney.
grasp the overall macro impact of these measures, but
okay, thank you. I think we know what the headline is in tomorrow's financial papers. We have Mr. McKay, please.
Thank you, Mr. Carney, for ending the Hallelujah chorus on that very favorable note. And I, too, I want to compliment the bank on its handling of the monetary side of the equation. It's a pity you didn't have support from the government on the fiscal side of the equation. But I would like to take note personally, and hopefully, and I don't know whether it's been mentioned by others, that Mr. Jenkins is usually with you, and this is probably the first meeting that he hasn't been with the governor over many years. And I just wanted to publicly say what a joy he was to work with over the years, and that he, when I was on the other side, he was extraordinarily helpful to me, both on this side and the other side. So a very fine public servant. You've obviously set out a window for bringing up the rates, and your words have been parsed ever so carefully by so many people. The concern that I have with respect to your raising the rates as anticipated is that the window appears to be about the same time as the governments of Ontario and British Columbia will implement HST, which likely will have a dampening effect on the economy. So the economy may well, on July the 1st, if that is the window, have a double hit. You're raising the interest rates and HST. I was wondering whether you've given that some thought, and if so, what is your reaction to that?
Thank you very much. I would like to join or add to your commendations for Paul Jenkins. He had an outstanding career serving our country, and was a tremendous help to me personally, obviously to the institution as a whole, over the course of the last couple of years, difficult years, and I do miss him at times, particularly at times like this. And I do look forward to being joined by Mr. Macklem the next time we meet. He will start on Canada Day as he fulfills his final obligations as Canada's representative on the finance side at the G20 and G8. And obviously with the summits coming up, it's important that he supports our Prime Minister and Finance Minister in that. With respect to and what was your question again?
So we got three events on July 1st.
Oh, the three events, yes.
HST,
Okay, got it.
and Tiff Macklem.
And Tiff Macklem, yeah. We don't anticipate any immediate impact of the arrival of Mr. Macklem. Yeah. Yes, of course, we've taken that into account. One of the things we've tried to highlight in the report is that we believe that there has been a pulling forward of some economic activity, particularly in the housing sector, some other consumption, for several reasons. One was the expiration of the home renovation tax credit and associated expenditure around that. Secondly, anticipation of changes in interest rates. And thirdly was the HST on new home purchases, but other purchases as well. So we anticipate that there will be a falling off in some of that activity in the second, but most notably in the third quarter. That is in our forecast. The question is, will it be more or less than we anticipated, and we will see. I would like to reiterate what I said at the start, though, that nothing is preordained. What we have done is taken away extraordinary guidance, exceptional guidance, unconventional guidance about the path of interest rates, which was necessary at that time. That time is passing. We've taken it away. And we are not going to provide guidance about the path of interest rates. The extent and timing of any additional withdrawal of monetary stimulus will be a function of economic activity and the outlook for inflation in Canada. And so those who are trying to divine what we might do should spend their time thinking, not parsing words, but thinking about the level of economic activity, the outlook for inflation in this economy, and where rates would appropriately be.
Very, very briefly.
Related question. Currently the banks have been raising their primes. You haven't. And I think Royal has raised their prime 3 times. Yes. And others. And the issue is that the government of Canada, the people of Canada, the taxpayers of Canada have been extraordinarily generous with the banking community, and yet when the first opportunity comes to put some space between what the Bank of Canada charges for their money and what the banks generally charge for their money, there doesn't seem to be some recognition of that. Does that disturb you?
Well, one point of clarification, the adjustments in rates have not been to the prime rate, they've been to the fixed rate mortgages of the banks. So it's
That's true.
And what's relevant for the fixed rate mortgages for the banks is the funding costs in fixed for the institutions. Now, what has happened over the course of the last several weeks has been that those funding costs have gone up. They've gone up, pardon me, for 2 reasons. 5-year government bond rates, same as the mortgage horizon, have gone up about 40 basis points over that horizon. They've been coming off in the last few days with some market activity, but broad brush, that's what's happened. And then the funding costs, the premium that banks have paid above that, have risen about 15, 20 basis points relative to that. So there has been an increase in funding costs, which gets flipped around and is passed through the mortgage rate. We haven't seen this adjustment in prime. What our responsibility is, obviously, is to look at what people are actually paying and making a judgment of what that's going to do for their activity and obviously inflation, and then we can adjust our rate relative to that. We are obviously, last point, alert to if there were any strains, which we do not see, in liquidity markets, as I discussed with Mr. Payet moments ago, if there's strains in liquidity or interbank markets, whether there is a role for the bank to alleviate those strains and have an impact there as well. But as I say, we're not seeing that.
Okay, thank you. Mr. Wallace now, please.
Just quickly, Mr. Chairman, I'll be splitting my time with Ms. Block. The one question. In 2011, the inflation target, or the strategy, is up for renegotiation or discussion. I think most Canadians would be surprised we have a strategy, but it's been in place since, I think, 91 or so, in that range. You pick 2%. Like, what's involved in that discussion? Who's involved? And is 2% because the public can understand 2%? Why is it not 2.2, 2.3? Like, how do you figure that out? I'd be interested to know, and I'm sure you can't tell me in 2 minutes, but do your best.
No, I appreciate the question, and I think it is important that I thank you for the question in part because I think it is important that Canadians understand that there is an agreement between the Government of Canada and the Bank of Canada that sets the mandate for the institution, and we're accountable to fulfilling that mandate, but it is delegated authority from the people of Canada through the Government of Canada. And why is the mandate 2%? And you're right, it has been. The inflation targeting regime has been in place through successive agreements since the early 1990s and does come up for renewal at the end of 2011. 2%, first off, is that there's a shared recognition of the costs of inflation, that those costs of inflation are disproportionately borne by poorer Canadians, people who have less access to sophisticated hedging products, other aspects, that they're distortionary, they distort investment and other activity, and they transfer wealth between savers and debtors somewhat erratically, depending on where you end up. 2% is one definition of low, stable, predictable inflation. The goal is to have that. And the reason that it has been chosen in the past, and we're revisiting whether this is the right, we have a huge research program on this, whether it's the right level, is that in part one of the reasons is it's low enough that it doesn't enter into people's thinking when they're making economic decisions. And there's a variety of ways of showing that. People sort of, when they do forecasting, when they take activity, they think, okay, inflation, 2% is relatively low. There might be certain, and they can make a distinction between rises in the relative price of a good and generalized rises in the price level. The second reason, very quickly, is that it's far enough away from zero so that given the volatility inflation, one would not expect to arrive where we are right now, which is at the zero lower bound, except in exceptional circumstances, because when one arrives at the zero lower bound of interest rates, the options become unconventional. Right. It becomes extraordinary guidance, it becomes quantitative easing, it becomes credit easing. So one of the judgments collectively will have to be made is whether it's still appropriate. You know, have we learned anything from the conduct of policy in Canada and elsewhere at the zero lower bound that would allow the target to be lower or a different regime to be put in place? And so we'll have information to make that more informed judgment and think about the trade-off of having lower inflation versus maintaining the current.
Okay.
I'm sorry, Ms. Block, but
there's about a minute left, Ms. Block.
Okay, really quick. Two statements that you've made in your opening remarks and in answering some questions. Early on, you said the largest risk is getting the balance right on fiscal policy. You also said that there is an extreme importance in the handing off to the private sector. And I'm wondering if you can just recap really quickly for us. I'm not sure if I'm the last questioner, but what our areas of focus should be in ensuring that those two things happen well?
Yeah, very quickly. And since you read the OEA speech, at the back end of that speech is reference to some fairly sophisticated work the bank has done. I'm happy to distribute it to the committee on what happens if governments get that balance wrong. If they don't tighten fiscal policy appropriately and global interest rates spike up and it hits potential growth, and it will ultimately hit Canada. And what happens if they do it too quickly or too abruptly because of market pressures? Same end result, in fact, a little worse, and what's needed as a package in order to get it right. That is in a nutshell, is the imbalances discussion as it currently stands, and that's why the G20 framework is important. And in terms of the handoff in Canada, what's required? It's confidence in macro policy. That means having a fiscal plan and implementing it. It means the bank doing its job. No more than that, doing its job. You know, having confidence that inflation is going to be low, stable, predictable. It means making sure that our financial sector is functioning, that the reforms are appropriate, there's not layering on too much capital, and it obviously requires as well a degree of confidence in the private sector in the outlook for the global economy, which unfortunately is beyond our control, but certainly our job is to inform Canadians with our best view of where the global economy will go.
Okay. Thank you. And final round is Mr. Mulcair, please.
Il nous reste très peu de temps. Donc,
I have very little time left, so I'll begin by saying something. First of all, thank you for your presentation, for the way you've addressed issues, and that's of great help to people listening. With regard to teaching tools, one of the things we've already addressed together, and you've gave an excellent explanation as to how the costs for financing costs for banks have increased and have led to increased mortgage rates. But historically speaking, with regard to the Bank of Canada rate and where it is today, the 5-year mortgage rates are quite high now. Do you draw a historical comparison in order to study various trends? Can you do so if you don't do it currently? Well, yes, we can draw up such comparisons, and we will be doing so if you so wish for the purpose of the committee work. But briefly, the return slope
you will have a more extreme historically difference between the overnight rate and the mortgage rate, plus the cost of borrowing of the institutions is a little higher in terms of a spread than you would have historically. But your question is a fundamental one, which is how does it look in terms of the extremes? And the easiest way to answer that is provide the information you just asked for.
Merci.
Thank you very much, Mr. Mulcair. Thank you very much, Mr. Carney. We certainly appreciate all of your visits here with the committee. We find them very substantive, very informative, so we look forward to your next visit here. And colleagues, we are just going to suspend for a couple of minutes, and then we'll come back in camera to deal with future business. Thank you again.